to speaking with everybody about 1031 exchanges. Got a bunch of material to cover here, so we'll kind of move smoothly, but I certainly welcome questions. If it's something I can tackle quick and it's in line with what we're talking about, we'll do that. Otherwise, I may ask to either wait if I'm going to get to it, or we can take it offline. I'm always available to serve as a resource. My phone number's there. You can connect with me on LinkedIn for updates that I post from time to time. You can get all my stuff from the QR code. So with that, we're going to talk about 1031 exchanges, why people exchange. Obviously, the tax motivation primarily, but there are some non-tax strategies that people are utilizing with 1031s. We will talk about the exchange critical deadlines, the timelines, and debt and equity rules that you should be thinking about when counseling clients on 1031 exchanges. We will touch on a few different types of exchanges. I'm going to focus today really on forward delayed exchanges, which are probably somewhere 90 to 95% of 1031 exchanges, where a taxpayer sells their investment first, typically because they need the money from that sale to fund their acquisition. But there are reverse exchanges and improvement exchanges also that I will touch on a little later on. 1031 exchanges go by a variety of names, like-kind exchanges, tax-deferred exchanges. So I'm going to use them interchangeably, sometimes referred to as starker exchanges. I'm going to sprinkle in some recent developments. We'll touch on probably some financing and seller financing, which has really become, I see a lot more these days, and we'll kind of discuss some of the interplay with 1031s. And then lastly, I'll close with the role of the qualified intermediary. So that's sort of our plan here. So 1031 exchanges have been around for over 100 years. And, I'm going to touch on in a little bit the Biden budget proposal, which has suggested capping 1031s. They've called it a loophole. It's anything but a loophole, being around for over 100 years, and there is no ambiguity to the code. Here we have that no gain or loss shall be recognized on the exchange. So we're going to flesh out these bold terms here. The concept of an exchange, what is real property, this concept of held for productive use in a trade or business or for investment, and lastly, again, like kind. By the way, I just skimmed over here. I am going to be referring to regulations, which sort of flesh out and give us a roadmap for using the tax code. But we have some revenue rulings I'll refer to and revenue procedures. So I have this for your reference. I think that Diana's either already sent you out the PowerPoint, or you can certainly reach out to me to get it. But anyway, I had that in for reference, wasn't intended to go through all of that in this presentation. So, of course, first and foremost, the tax motivation. So for investment property that has been held longer than 1 year, we have a long-term capital gain at a top rate of 20%. For assets held less than a year, that would be ordinary income tax. And we'd want to have a conversation as to why a taxpayer is contemplating a 1031 exchange for an asset that has been held less than a year. There are certainly scenarios which lend to doing that, and so I'll touch on that in a bit. Depreciation recapture tax, a accounting expense taking into account the useful life of an asset. For residential property, 27.5-year straight line. For commercial property, 39 years. So while that creates an offset against the rental income in any respective year, when that asset is sold, but for a 1031, there is a recapture of that depreciation in the amount of 25%. And there may be situations where cost segregation studies have been done on the improved property, which would accelerate the depreciation further. State income taxes, of course, we have certain states, Florida, Nevada, Texas has none, up through California with north of 14%. So that too can be deferred through the exchange. And lastly, the 3.8% net investment income tax, Medicare tax, often referred to as the Obamacare tax. So a lot of taxes that are due upon the sale of appreciated investment property But fortunately, the 1031 exchange can be used to defer all of it, or it can be a partial exchange to defer some of that. Now, along with those tax motivations, there are strategies around doing the exchange. First and foremost, diversification. And there are many misconceptions that I hear around how an exchange works. So I hope to be demystifying those throughout. So first and foremost, diversification. So a taxpayer can sell a single asset and diversify into multiple assets. So if somebody is selling a two-family or a shopping center, they can sell that asset and trade into two assets or three or potentially even more. So it is not just simply a single asset sale and a single asset purchase. That does not have to be the way that the exchange works. Diversification in a second form geographically. So a taxpayer may sell a single property here in New York, but they can diversify into real property anywhere in the United States. So anything, and that includes the Virgin Islands, Guam, North Mariana Islands, if any of you are doing business there. Interestingly enough, it does not include Puerto Rico. So Puerto Rico is treated as foreign property, and foreign property can be exchanged, but only for other foreign property. So you can never trade into or out of the U.S. in an exchange. It has to be U.S. for U.S. or foreign for foreign. Okay, so that's sort of diversification geographically. And then lastly, by asset class. So again, oftentimes I hear somebody say, well, I'm selling a two-family, don't I have to buy another two-family? So the answer is no. This notion of like kind in the context of real property is that all real property is exchangeable for all other real property. Okay, so that's the concept of diversification. Now, conversely, a taxpayer may have multiple assets that they have accumulated over their investment career and life, and they have the ability to roll those various assets into a single asset. So they may create efficiencies in having a single asset. Their time is better spent not bouncing around with a variety of tenants and variety of geographical locations. So many times people do that. Now, you should be aware that in doing a consolidation, the timing may be a challenge. And we're going to talk about the critical deadlines, but that might be something to think about is, are we going to get those various assets sold in short order to exchange into a single larger asset? The other thing that should be thought about is how title is held to those various investments. If the same taxpayer owns the 4, 5, 10 properties that are going to be sold, it makes it easier to sell them and do an exchange into a single asset, as opposed to if there are different partnerships that are owning the various investments, it is going to make it challenging to buy the replacement property. They would have to acquire as tenants in common, as opposed to, because you can't create a new partnership. So we're going to talk about that. Now, cash flow, raw land can be exchanged. Obviously, we don't see a whole lot of that in. Okay, so let's get back to where we were there. Sorry. So I'm not quite sure exactly where I fell out there, but somewhere around here, I suspect. Okay, so we talked about diversification, consolidation. I talked about cash flow. Hopefully that part was included. And estate planning was the concept about tying in these various strategies where taxpayer may have two heirs and they may be geographically diverse. And so you could sell that single asset, buy multiple properties in different geographical areas that ultimately will be left to the heirs. Or it could be a function of a significant other that's not in a position to manage the property. So to trade out of that and get into passive property that would generate income and not require any management responsibility. So again, as we saw in the code, we have to have these 4 statutory requirements that we are dealing with real property, that property is held for business or investment use, the properties are like kind, and this notion of having an exchange. And this is what we're going to flesh out throughout here. So first and foremost, let's just talk about this held for, because this is always the question I get is, well, how long do I have to hold the property? And time is only one factor, and it's always really about intent. So we look at the facts and circumstances, consider the risk tolerance of the taxpayer, as well as their behavior to determine, do they look more like a dealer or are they really holding things for investment? And I will say that it is very helpful to loop in a CPA for them to advise as to how this property has been treated. And that might be a function of a residential property or a multifamily where the taxpayer may even live in a portion of it. And so we'll kind of get boxed in by virtue of how much was depreciated. It's always good to have a little dialogue with the CPA, among other things, to determine if they even have a gain that warrants doing an exchange. But when we talk about this intent that must be satisfied here, we have this Brecher case. And essentially, the intent is that the taxpayer doesn't plan to liquidate the investment, right? So it's not for flippers that are buying a single family, a little spackle and paint, give it back to the realtor 30 days. Their intent is not to hold the investment. It is to resell it. So that's not good. And then neither is to use it for personal pursuits. So there are some safe harbors for second homes, vacation homes. We'll talk about those personal pursuit situations, but that's the intent that we're really looking for. Now, that's all well and good for me to say. People say, how long do I have to hold something? And I say, the longer the better. Now, if they're really going to pin me down, gun to my head, I'm going to say 2 years. Now, why am I going to say that? Well, we have this old private letter ruling, of course, only binding on the taxpayer that sought it, but it's there. We do have some 2-year holding periods within the 1031 exchange context for second homes and vacation homes, as well as for related party transactions. So I think that 2-year really seems to be good. It's always going to be up to the taxpayer as well as counsel as to advising, and the CPA for that matter, their comfort level around maybe something a little shorter. But here we have this Neil Baker case, and you can see property was held for 11 years. So what gives? Well, what gives here is that this was a quick serve restaurant operator that did acquire land that was going to be for development. Now, on their books and records, this land was held as works in progress. It was not held for investment. So it was essentially inventory to that taxpayer. So again, that time period is not a bright line rule that gets you anywhere. It's always going to be about intent. So I'll take you through a few residential scenarios and how these played out for consideration in guiding clients with their exchanges. Now, in this Adams case, a taxpayer bought a property through a 1031 exchange, and their son proceeded to do significant amounts of work to the property. There were bears in the property and mold, and so significant improvements. And that son paid to the parent close to fair market rent. It was a couple $100 below fair market rent. They were challenged and initially lost. They took it up through the tax court and prevailed. But the takeaway here is, if you have a client that's buying an investment, let's say in Manhattan or a single family, and they're going to put their kid in it to just pay the mortgage and the carrying costs, common charges, maintenance, whatever it may be, that is not going to suffice. There should be a lease agreement with rental income going to the owner, taxpayer. So that's really the takeaway here. In this recent case, taxpayer bought a property through an exchange, and 8 months later, they moved into the property. Now, they had financial setbacks. They made efforts to rent it out. I don't think this is anything that you're going to hang your hat on. But again, it's there in a situation where they evidenced that they intended to treat it as a rental, circumstances changed, I think they were maybe a little sympathetic to this taxpayer, but again, 8 months later, taxpayer moved into the property they acquired through their 1031 and prevailed. This Goolsby case, lots of bad facts here. Taxpayer bought a property through their exchange, and they bought it and moved into it 2 months later. Now, they bought a property in a homeowner association that didn't allow rentals, right? So that's very similar feel to many co-ops that typically don't allow investors, right? Or they allow you to rent after you've lived in it for a couple of years. You really have to look at the house rules, et cetera, building by building before, suggesting that a client buy a co-op through an exchange. In this particular, with this Goolsby, they also reached out to the qualified intermediary and said, hey, how soon can I move into this property I bought through a 1031? Again, bad fact, right? We talk about Bolker, intent not to use it for personal pursuits. So that was a bad fact there too. This La Paloma case, taxpayer bought a property, never rented it out, and they used it significantly through the course of their ownership. What was also sort of a problem here for them was that they took a mortgage for an owner-occupied rate. Now, why did they do that? Of course, it was a lower interest rate. However, in doing a 1031 exchange, they clearly, unless it was a it was a 2-3 family where the lender said, yes, you will give you that rate. We understand you're living in one unit, you're renting out the other. This was a single occupancy, single use property. So, you pick your poison. You either committed mortgage fraud or tax fraud here in your exchange. So not a good situation there. Now, Revenue Procedure 2008-16 is that guidance for second homes and vacation homes. And I'll try to really boil it down to the important takeaway, which is as follows. For 2 12-month cycles before the taxpayer sells a second home or vacation property, and for 2 12-month cycles after they acquire another second home or vacation property, they must rent it out for at least 14 calendar days. Also, during all of those 12-month cycles, the taxpayer cannot use it personally the greater of 14 calendar days or 10% of the amount of time that they've rented it out. So I've never had anybody fall within the safe harbor amongst my colleagues. I don't know anybody that's had anybody fall in it, but I think it provided some guardrails around second homes and vacation homes, which long ago, and again, this went into effect in 2018, but there were many that were promoting and doing exchanges around second homes and vacation homes. So I think this sort of, kind of, again, created those guardrails, and I think it weeded out a lot. Now, we take some cues from it to the extent that somebody sells a shopping center and buys a condo on the beach in Florida. I think it's fair to say that if they, in fact, rent it out for at least 14 calendar days over the next couple of calendar years and limit their personal use, as I had said, I think they should be okay. So I think that's something that's an important takeaway from there. So as it relates to this concept, again, of real property, and I'm going to talk about in a moment the Tax Cuts and Jobs Act, we have to, again, have property that is held for investment, not intended to be sold. So all the things you would expect by way of real property along the left-hand side, I will point out net lease property, again, triple net leases, very prevalent passive investment strategy, along with Delaware statutory trusts. Now, Delaware statutory trusts came about in 2004. They were blessed by the IRS as both relinquished property or replacement property for 1031 exchanges. They are technically a security sold to accredited investors, and they are essentially institutional grade property for which a taxpayer can get a co-ownership interest. We haven't seen a whole lot. Now, the things in green here were also, again, new from the Tax Cuts and Jobs Act. Co-ops, of course, are treated as real property in New York. You certainly look to whatever state to determine if whatever the asset is treated as real property. The reason it's here is because in the Tax Cuts and Jobs Act, there was a suggestion when they were initially fleshing it out that they were going to look to federal law. Fortunately, we do look to state law to determine if something is real property. Haven't seen a whole lot of options in play, but that's going to be interesting going forward. Now, things that don't qualify are stocks, bonds. These actually, all these bold bullets have been removed from the code post Tax Cuts and Jobs Act. Stock, I'll just point out, REITs, real estate investment trusts, are not eligible for 1031 exchanges as either relinquished or replacement property. I think there's some confusion out there because there are some Delaware statutory trusts, as I just mentioned, that through a 721 UPREIT transaction convert to operating units and REIT shares. So that is a strategy that you can do, but upon sale of that stock, unless there's been a passing of the taxpayer and a step up in tax basis, or unless there are some losses that can be harvested against that stock sale, they will owe their taxes upon the sale of the stock. Partnership interests are not exchangeable. And so it's important to note that if you have a taxpayer that has a partnership, they don't get to just take their share and do their exchange. I am on a weekly basis confronted with this situation. Now, in a perfect world, well in advance, years in advance, let's say, a partnership maybe would be converted to a tenant in common arrangement. And that ultimately would allow the taxpayers to go their separate ways. I mean, it would have to truly be treated as a TIC, tenancy in common, often not feasible or practical, because if there is financing on the property, that lender is not going to allow that. I mean, you could reach out and see if you can get permission. It's not something they typically are interested in having. So that's something to consider. And that's what we call a drop and swap, where a partnership is dissolved and or it might be just one partner redeems their interest in the partnership in exchange for a TIC interest, allowing them to simply cash out or to do their own exchange. So that's one strategy, the drop and swap. There's also a swap and drop strategy where the taxpayer sells the property, buys multiple replacement properties, which will ultimately be turned over to the various partners to dissolve the partnership. There are partnership divisions. There are partnership installment notes. So a lot of strategies around this, but the important point is you don't get to just take your partnership interest and do your exchange. And similarly, you don't get to just buy a replacement property partnership interest. So I can't just sell a property as Eric Brecher and buy a replacement property with a friend and say, you know, we're going to set up ABC LLC. That does not work. So that's something to think about. Now, I would be doing you a disservice if I didn't point out, because this is just an attorney call, a little nuance that might still be available to the taxpayer. Revenue Ruling 99.5 allows a taxpayer to sell, if they have a single member LLC, sell a property and just, let's say, a 50% membership interest and do an exchange out of it. So if I own 123 Main Street through XYZ LLC, I'm the sole member, I own 100% of the membership interests, I can sell to Diana 50% of my membership interests, and I can do an exchange via Revenue Ruling 99.5. Now, she cannot do an exchange buying that membership interest if she has an exchange. However, let's take a scenario now where Diana and I own a property 50-50 in an LLC, and I sell some other asset. I can buy via Revenue Ruling 99.6 Diana's 50% in the LLC that I don't currently own because I come away owning 100% of that LLC now. So that has been blessed for purposes of that purchase of a partnership. But again, she can't sell that partnership interest and do an exchange. I was just getting an unstable internet. Okay, so that's a little bit on that. Primary residences not eligible for a 1031. We have the Section 121 tax exclusion for a primary that a taxpayer has lived in and used as their primary 2 of the last 5 years. The first $250,000 of gain is exempt from tax for a single person, $500,000 for a married couple that files jointly. Just an article in Wall Street Journal the other day about how that was not indexed for inflation. So that's been around since the 90s, but that's what it is. Now, we do have the ability, if somebody has a 2-family or some accessory dwelling unit to their property where they live in a portion and they rent out a portion, we can bifurcate that sale. They can get that Section 121 exclusion on their primary piece and utilize the 1031 for the investment piece. All right. Recently, a water right PLR, again, only binding on the taxpayer that sought it, but these were perpetual in nature and they are like kind for purposes of real property. We would expect that similarly situated taxpayers would be treated the same. We also had transferable development rights. I've been involved with air right deals for many, many years. And, this is something not surprising to me, but it did sort of in their particular fact pattern, which was a little bit interesting, they were able to acquire those. So, as I mentioned, 1031 exchanges have been around for over 100 years, since 1921. And once upon a time, it was essentially used for cattle, for aircraft, artwork, machinery, equipment, all sorts of things through the years. And it was this, very rigid simultaneous transaction where maybe Diana had a piece of real property or cattle and I had cattle or real, and we would swap deeds or swap, the asset. We now have these deferred critical deadlines that we're going to talk about. But what we also got was, because of the Tax Cuts and Jobs Act, which went into effect in January of 2018, 1031 exchanges are only available for real property. So no longer can you do it for the aircraft, the artwork. But that sort of begged the question, so what is real property? So we did get final regulations in December of 2020. And so we have 3 tests, essentially. The state law test, all things state law, as I mentioned earlier, like the co-op, are eligible for 1031 treatment. The listed assets test has a whole litany of real property, all the improvements in land and everything you'd expect, including pools and fences and tunnels and bridges, on and on and on. It's there, it's treated as real property. And we kind of have this fallback factors test to determine if something is really affixed to the property with no intent to move it, it would be so costly to move it, it will be treated as the real property as well. Now, for purposes of qualified intermediaries working with taxpayers, sometimes there is personal property involved in the acquisition. So, for example, a hotel which has televisions and beds and maybe sophisticated gym equipment, etc. We now have a safe harbor as a qualified intermediary that we can release up to 15% of the purchase price of the acquisition for personal property. Okay. In the past, I'd have to say to a taxpayer, I can't release your money for things other than real property. So now we have the safe harbor that allows us to release. Now, it is not going to be like kind. They're going to have a tax issue if I'm releasing money for personal property associated with the exchange. Now, it came up, Richard asked me earlier with regard to the Biden budget proposal. Now, I was just in DC. Actually, before I do that, I think we've got to announce a code, Diana. So am I doing that? I think we determined we were going to do CDEC 1031.
Yes, and I will type it in the chat so everyone sees it as well.
Perfect. So again, that was CDEC 1031. Make sure you get that in so you get your credit. All right, so carrying on here. So again, this Biden administration once again has proposed capping 1031 exchanges to $500,000 for an individual taxpayer and $1 million for a married couple. This would obviously devastate the real estate industry. we engaged a couple of economic studies, one with Ernst & Young and another with some economist, Ling Petrova, who, I'll just give you a couple of quick takeaways, determined that 1031s support almost 1 million jobs. Okay, that's a significant number of jobs. Creates $48.6 billion of labor income and adds almost $100 billion to the gross domestic product of the United States. The scoring of doing away with 1031 suggests it would raise $1.9 billion in taxes revenue. However, our studies that we engage show that we are contributing $19 billion through 31 exchanges on an annual basis. So, you think about it, there's transfer taxes that the local governments are getting. There are jobs supported when a taxpayer does an exchange and buys a single family and improves it and puts the roof on. It trickles all the way down to local trades. So, again, that's a little bit on that. I was in D.C. last month with our lobbyists on Capitol Hill, and I don't see any legs on this at the moment on the House or Senate side. So, but we're in there educating, and we do have this website here. You can always visit, learn, see the studies. You can reach out to me to, get any further information. But, 1031s are a very important driver for a lot of reasons, removing friction to the marketplace, creating that liquidity. So now, again, this exchange requirement, very important. Just the other day, I unfortunately had to be the bearer of bad news to a taxpayer who called me and said, hey, I'd like to do an exchange. And I learned over 18 years ago when I got in the industry, my order of questions. And my first question to them was, when's your closing? And they said, well, I closed a week ago. I said, well, this conversation's going to be short because there's no 1031 I can help you with. It is imperative that before the closing occurs, I am involved getting a copy of the contract, title, corporate or trust documents related to the taxpayer, and set it up as an exchange, as opposed to just simply a sale followed by a purchase. And I give a 1031 ethics CLE as well. I encourage you, if you are working with somebody that clearly it's a multifamily or it's a shopping center, that's an investment property. Even if it's a condo or a single family, ask the question. Have you rented this out? You may want to learn about a 1031. I can connect you with somebody who can educate you about it. Talk to your CPA about it. Something. I would pad that file if I were you. I raised the concept of a 1031, and they told me they don't have a tax issue. They're, listen, there's a reason. They just want the money. They don't want to own real estate anymore. There could be reasons. But I would cover yourself, and I would put that in your file that you raised the concept of a 1031, they didn't want to do it. Now, these are some of the core tenets of doing an exchange. And again, many misconceptions around this. And I'll just kind of boil it down to a couple of things here. In order to fully defer all of their gain in tax, which again, it's not an all or nothing proposition, but we just position it this way. All of the net equity from their sale, meaning after their broker fee, their transfer taxes, customary closing costs, paying off the mortgage, all of that net equity must come into the exchange account that we establish. For them to defer all of that, they need to spend all of that net equity, but also they must replace any principal balance of a mortgage that is paid off. And this is where I get all this, questions regularly. I thought I only have to reinvest my gain. No, not the way it works with a 1031 exchange. Or they say, I thought I only have to reinvest my cash, my equity. No, not the way it works. So again, you have to reinvest all the equity. You have to replace the debt. Now, you're not forced to take another mortgage. If you want to come out of pocket and substitute debt with fresh equity to buy something all cash, you can do that. I'm just, in the interest of time, going to keep moving. We're going to close with the role of the qualified intermediary, of course, the role that I perform. Real quick, again, great conversation for the CPA, but just to understand what their adjusted basis is in the property that they're selling, you simply take their purchase price, assuming it was outside of an exchange. You take their purchase price, you subtract the depreciation over the course of their ownership. You add back any capital improvements that were made, and that gets you, and you subtract that from the relinquished property sale price, and then we have our realized gain. So again, the purchase price minus depreciation plus capital improvements gives us the adjusted cost basis. Subtract that from the sale price. That is your realized gain. Now, the objective is not to recognize that gain. Now, you can see in this scenario, and this is using an 8% average state income tax, you have a $330,000 tax bill to the taxpayer. So, that's two things. That's a hit to their net worth, first and foremost, unnecessarily. And secondly, that $330,000, if it were reinvested in a 5% investment, just that tax, that's $16,000 a year lost in perpetuity. Okay. So now to the critical deadlines. Again, you want to make sure that you have what we call some cooperation clause language in the contract of sale. Also want to have that in the purchase contract. I'd encourage you to just make it boilerplate. Even if it's your best friend selling their single family and it's not an investment, well, maybe the buyer is going to buy it and treat it as an investment. So put the language in there, make it reciprocal. That would be my thought to you. But again, I need to be involved prior to the closing. At the time that title passes to the buyer, and by the way, it is direct deeding to the buyer. So we don't go on title. Title passes from the seller to the buyer, and we are going to trigger two critical deadlines. So 45 calendar days to identify a replacement property, 180 calendar days to close on one or more of the identified properties. Okay. I'm going to not get into some nuances around year-end transactions. There are on occasion federally declared disasters. Again, great conversation for the CPA to have them bless whether your client is an affected taxpayer or otherwise has difficulty meeting their deadlines. It typically will extend it 120 days. There are sometimes a date certain that they'll put out there as well for the extension. There's a question in here. Is the debt which must be rolled over to the replacement property limited to mortgage debt? Well, I mean, what other debt? Are you asking about if it has to be secured or, they must have debt. Again, it can be replaced with new equity, and you certainly can take on more debt if you're rolling all your equity in. So I don't know what's being contemplated by the question, but I don't know, maybe you'll clarify. So with regard to identification, within 45 calendar days, so there's no exceptions for Saturdays, Sundays, or holidays, taxpayer must complete a form and return it to me by 11:59 p.m. The most commonly used method is the 3-property rule, where a taxpayer lists up to 3 acquisitions, and it does not matter the value of those properties. They are simply limited to 3. So they can utilize backups, or maybe they intend to buy multiple properties, but that's the 3-property rule. So in our example earlier, sold for $2 million, they can list 3 things that are $20 million each. Now, if they want to list more than 3, because either they don't know what they want to buy or they plan to diversify into more than 3, the 200% rule allows them to list 4 or more. But now, in addition to each property address, they must add the fair market value of each property. And in the aggregate for those 4, 5, 10 properties, whatever it is, it cannot exceed 200% or 2 times the sales price. So that's the 200% rule. Now, the 95% rule does not lend itself to real estate. It was used really in personal property context. But if a taxpayer is trading into multiple properties beyond 3 and beyond 200%, it serves as an exception. Really, you're only going to use this if it's a portfolio acquisition, all or nothing, or any property acquired within the first 45 calendar days is treated as properly identified and received. Now, in all identification methodologies, if the taxpayer is not buying 100% of the property, they must list that percentage interest. So if it is a tenancy in common interest, list they're buying a 50% TIC interest. Or if it's Delaware statutory trusts, for example, list a 1.74% interest in whatever that property is. Now, identification is a form that we will provide to them. It should be signed, dated, returned to us. We are all exchanging everything through email, right? So I am going to hope and expect that it's not going to be suggested that the taxpayer licked the stamp, put it in an envelope, and sent it to me. Now, that is permissible to do, but really what people are doing when they're doing this is there are qualified intermediaries that are taking late identifications or playing other kinds of games, which quite honestly, simply, it's tax fraud, right? So this is an unregulated industry, unfortunately. As was stated earlier, I work for a subsidiary of a $50 billion bank. We are subject to government oversight. So that is something you should be thinking about as it relates to your choice and working with a qualified intermediary. You know, the regulation certainly does not hurt. Now, so that's, again, a little bit on identification. Now, when the funds are being held, these funds are not a checking account for me to just release money for whatever they'd like, right? So if there is a desire to have some money, as I mentioned earlier, 1031 is not all or nothing. I can carve out, you know, any amount of money, 50, 100,000, whatever they don't want to include in their 1031. You obviously need to know that because you're going to need to cut them a check or wire them whatever amount they want if they don't want to include it all in their exchange. Understanding they will have a tax issue on that amount. But when the money is in, it's important to understand that I don't have the ability to just release money for anything. Again, it can be released for an environmental appraisal, an earnest money deposit, and of course, ultimately to fund the acquisition. These are just a couple quick examples I'll rattle through. You know, you may have heard the term BOO, which does not appear in the code or the regulations, but it does mean tax. So as we talked about, we're going to run through three quick examples here. Selling for $1.5 million, paying off a $500,000 mortgage, leaving $1 million of equity. I'm not factoring in closing costs. So in the first example, they bought another property for $1.5 million. They put their $1 million of equity into it, and they replaced their debt of $500,000. So all looks well in the world here, right? They spent all their equity, replaced all their debt, no recognized gain. Now, this example is what we call cash boot. And, you know, this is where I hear people flippantly say, oh, yeah, you know, 1031s, you just have to buy something equal or greater in value. That statement is not correct if you are not adding the caveat that all the equity from the sale also went into that acquisition. Because here, taxpayer bought for $1.5 million, but they have a tax issue here. Why is that? Because they only put $750,000 of their $1 million into the acquisition. So they did replace their $500,000 of debt at the end of their transaction, and this is assuming they're not planning to buy anything else. I am going to return the $250,000 to them, but that's cash boot. They're going to have a tax issue on that. Now, the most damaging is mortgage boot. Here's a situation, and of course, the light bulb antenna should go up here. Well, they're only buying for $1,250,000, so something's got to give, right? So in this case, they did reinvest their entire $1 million, but and by the way, in this example, they came out of pocket with an additional $250,000, so they didn't even take on any debt. But that $250,000 replaces it replaces half of their $500,000 of debt that they needed to replace. In this situation, they didn't replace the full $500,000. They are going to have a tax issue on the $250,000 of debt that they didn't replace. Okay, that's mortgage boot. Now, we've been talking again about forward exchanges. I do want to very quickly talk about the fact that there are is all of the boot taxable, or is there some? Yeah, it's prorated. So in other words, if you don't spend the $250,000, let's say you had no basis, you're going to owe $80,000 in taxes, just using roughly a third. So it's not the full $250,000 taxable. It will be prorated. Yes. So we've been talking about forward exchanges where the taxpayer sells first and then uses the funds from the sale to make their acquisition. But there is an ability to acquire the replacement property first. And there is an ability to trade down in value and use that excess money to make improvements. But because you can't own two pieces of property at the same time and do an exchange with yourself, and also you're not permitted to do improvements to property you already own, we have this revenue procedure 2000-37, which allows for what are called parking arrangements or reverse exchanges. And I'm going to really oversimplify it. But what will happen is we will perform a separate function from a qualified intermediary, what's called an exchange accommodation title holder, referred to as an EAT, an EAT. And for federal income tax purposes, we will sit on title to that replacement property on their behalf through a new LLC. And so when we go on title, that is going to start 45 calendar days for the taxpayer to identify one of their existing holdings that they will sell within 180 calendar days. Obviously, the taxpayer needs to be in the financial position to buy the replacement property before selling their existing investment. But I do, as our firm, between 10 to 20 a month of these. So it's regularly done. And, it might be a function of a purely opportunistic buyer. It may be a function of, when something's used in their trade or business and they want to expand their warehouse and they have a very limited geographical area that they need to be in, and they need to make sure that they can secure something, they're confident they'll get their property sold. And so again, in a situation where a taxpayer sells first, so switching gears to an improvement exchange, taxpayer sells first for $2 million, buys a replacement for $1.5 million, and wants to use that other $500 to make improvements, we can structure it similarly where they will have that 180 days to use the money from the exchange account to fund the improvements. I'm just going to touch very quickly on this because this is something that comes up from time to time about refinancing the real estate. So, oftentimes people say to me, I'm selling a property, I'm selling it for $2 million and I don't have a mortgage on it. And this is all well and good, but I'd like to see some liquidity, or I need liquidity. So, again, we've talked about if you sell something for $2 million, you have no mortgage, you have to go out and buy something for at least $2 million using all the equity. But, there may be reasons they're moving, they want to rotate their asset, whatever it may be. It is possible to refinance that property, and that is a tax-free issue to the taxpayer. There's no tax on the refi. That loan must be repaid. But the problem becomes in the 1031, if you are refinancing immediately before the sale, there were some proposed regulations that would suggest that might be boot, and that by you doing that right before you're closing, you're going to have a tax issue. So unless there's some independent economic reason that you're doing that, I would suggest maybe waiting into the replacement property. So we do have, and despite there's not a whole lot of authority to this, we do have this notion put forth of what's called a nanosecond rule or a 2-pen rule, where you complete your acquisition and then you pull out your other pen, or a nanosecond later, you refinance that replacement property and pull cash out. So those are some things to think about regarding financing. I mean, obviously, there's a variety of expenses involved. It would seem you don't want to do that right before you're going to sell a property anyway, and then just have to pay it off. But again, if there are those independent economic reasons, again, maybe the loan's becoming due, maybe you're doing this for purposes of buying other property through your exchange. There could be some reasons that make sense. I also want to touch on here seller financing, which is coming up more and more. And I want to encourage you, despite I know, it sometimes will bridge the gap in having a deal happen. The problem is that it doesn't play well with 1031s. if a taxpayer sells something for 2 million and the buyer can only come up with $1.5 million, and the seller says, all right, well, we'll do seller financing and you owe me 500,000, we'll do a 5-year balloon, you owe me interest, whatever it is. The problem is I'm only receiving $1.5 million in the exchange account for the tax. So they don't have the full 2 million. Now, under installment sale treatment, 5 years from now, they'll have that tax issue. But oftentimes they don't want that tax issue then either. So if they're in the financial position to lend the money to the to the purchaser outside of the exchange, or otherwise buy their note out of the exchange, qualified intermediary would need to be the beneficiary of that note. They buy it out, so now they've put that 500,000 into the exchange account. Now they are able to fully defer all their gain in tax. The other way it could work, I've never seen it happen, don't know anybody that's had it happen, is that the buyer's note is used for the taxpayer when they buy their replacement property. So they go to the seller, they go, here, I have $1.5 million of cash, and guess what? Here, Joe Schmo bought my property, and here's a note from him for 500,000. Well, I'm not interested in that note. Maybe if it's Elon Musk, I'll take it. So that's the practical nature of that happening. So again, in closing, my role as a qualified intermediary, I am an attorney, but I do not give legal or tax advice. Anybody that has served as an agent of the taxpayer, you as their counsel, the accountant, the realtor, their employee, anybody that served as their agent over the prior 2 years is a disqualified person and cannot serve as the qualified intermediary. So again, we are the one with whom this legal fiction is created, this tax fiction that the taxpayer is exchanging with me. There's an assignment of that contract of sale to me, and then ultimately on their purchase, there's an assignment of their purchase to me. So technically, they are doing the exchange with me. And that's the role that the qualified intermediary performs, in addition to holding the funds after that sale occurs. The taxpayer cannot take actual possession of those funds. Similarly, you cannot hold the funds on behalf of the taxpayer. That is constructive receipt of the funds, and their exchange fails. Now, don't get me wrong. You are permitted to hold the earnest money deposit up until the time that the closing occurs and title passes to the buyer, at which time those funds should be released to the qualified intermediary. So in thinking about a qualified intermediary, again, first and foremost, understand the security of who you are working with, understanding that 99% of the industry is not regulated. We have seen Ponzi schemes. We've seen bankruptcies. There's an entire episode on American Greed on CNBC about QI defalcations. So I am a subsidiary of a $50 billion publicly traded bank. We are not a title company. Don't let the Chicago name fool you. Nothing to do with any title company, although we appreciate judicial title, and I hope, and they hope you will think of them. But I just want to make it clear we're not a title insurance company. By way of service, everybody works directly with me. The phone number that is right here and that is on my thing is, unless I'm giving a presentation or otherwise, but everybody works directly with me. And this is my cell phone, and I'm always available to serve as a resource to answer questions for you or your clients. And with that, I think we're right at the top of the hour and landed the plane on time. So
perfect timing. I wanted to thank you again for a great presentation. Everyone really enjoyed it. I will, just as a reminder, I will resend everyone the material and the affirmation and the evaluation along with Eric's information should you need it to reach out to him. Thank you again, and we will see you next time.